Hello everyone. Today we're going to talk about some of the trends that are widely discussed in the markets right now. Let's start with inflation expectations. Inflation expectations have been rising quite significantly in the past, particularly 4 months, and they have been even further confirmed with the data coming from China of its PPI, of the production prices. One of the things that worries me about these inflation expectations is that they are coming predominantly from the expectations of crude oil prices, commodity prices. Core inflation is not rising as expected. The US is different. In the US, core inflation is actually rising above most market expectations. But throughout the rest of the world, and particularly in the OECD countries, core inflation remains very subdued. So we have to be very concerned at least about the fact that inflation expectations come predominantly not from higher growth, better demand estimates, but from the fact that supply cuts and monetary policies have moved some of these commodities. So let's be let's be thinking about this from a more prudent perspective than some commentators are. I think that the fact that bonds and bond yields in most OECD countries have started to relax and have continued to see a little bit less of an outflow than in the previous months is an indication that market commentators and market participants are finding it more challenging to believe in this boom of inflation for 2017. Let's pay attention to core inflation. Let's pay attention to what happens in the US with the Trump policies, and let's be very focused about those differences in that core inflation, which is the key element. Moving on to bonds. One of the biggest risks in the market right now is the pricking of the bond bubble that has been generated in this last 8 years of massive stimulus. Where are the main risks? Funnily enough, the main risks lie in the ultra low risk bonds, the ones that have been yielding negative returns in the past months, and more importantly, the ones with 0 to negative yields, as well as the high yield ones. Why? Because as the US 10-year rises in yield and as inflation expectations, be them more or less subdued, improve, what we have is a risk-reward that is completely imbalanced between those negative yielding bonds that reached $11 trillion in the market and the high yield bonds in which you had companies that were not improving in their ability to repay their debt, issuing paper at much lower yields. So those areas are the ones in which there is more risk, but there is still value in bonds. Let's not forget that. Finally, let's talk about commodities. Everybody has been very excited, I don't know why, about the fact that oil prices were rising. But we have to remember that oil prices have only reached $53, $54 a barrel, with one of the most important cuts, OPEC and non-OPEC, seen in recent history. So we have seen the front end of the curve rising, but not the long term. The long term has been very, very stable. We have to be very worried about this. We have to be concerned also about the fact that commodity increases come from supply cuts, not from improvements in demand. But furthermore, is that those supply cuts are being offset by an increase in production from the US and from independent producers. So we have to be very, very, very at least cautious about this recent boom of expectations about commodity prices, about crude oil prices. We need to see demand improving. China is not helping in that front, and therefore I think that we need to be cautious. Those three elements, bonds, crude, and inflation expectations, are three key elements about expectations for 2017 that we should be very much on top to confirm or to deny expectations of improvements in the economy. Thank you so much.